Hello everybody, my name is Howard Reisman. I'm the CEO of Rover, and today I'm going to do a webinar on finding great stocks with our new quant-based stock screening facility. If you're not familiar with quant-based stock screening, I'd recommend first watching our Rover webinar introduction to quant-based screening, which is just under 8 minutes. It's posted up on our website, and then watching this webinar. But assuming you're somewhat familiar with the Quant facility, I'm going to jump in and I'm going to use the capabilities of the facility to find some interesting stocks according to some different quant-based investment styles. So with that said, let's just jump right in. And what you should see is my screen as you log in. This is pretty much a new user will see a screen similar to that. The only difference is in my screeners, we typically populate that with a number of out-of-the-box screeners and quants. I've deleted them all for the purposes of this demonstration because we're going to create a new set of quants from scratch. So the first quant I want to work with is one that's I'm going to call big dogs with growth. And what this is very large companies that are growing rapidly. So let's go about constructing this screener. So we go to my screeners and we right click and indicate that we want to create a new screen, and it gives a default name, but we're going to change that to big dogs with growth, and we're going to give it a description, and we're going to call this, give it a description, the biggest fish that is still growing. We're looking for large cap companies that are still exhibiting significant sales and earnings growth. So the question is, how do we go about building a quant that does this? So the first thing we do is we check the use advanced quant features here to indicate that we want to do more than just screen. The primary difference between screening and quant is that screening will just give you a list of the stocks that pass all the criteria. Quant will then rank them from one to the last one according to the weightings that you assign to each of the criteria. So that allows you to be more efficient with your screening because you can basically focus on the ones on the top of the list because they scored the highest according to the investment criteria you care about. It also allows you to be a little less restrictive with a number of the filters because if more companies pass, say you have a screener where you have 100 companies pass, that would be a fairly big deal with a screener to research that many companies. But with quants, you can do that and then just focus really on the higher ranked ones, and so you can be a little less concerned about the actual criteria that determines how many companies pass. One thing you can do that's quite nice is you can restrict here. You see the limit, which is set at 50, the number of companies that will be returned. So even if my criteria allows for screening of way more than 50 companies to pass, I'll only see the best 50 ranked 1 to 50, which is nice. So that's the basic advantage of quant. So let's go and build this screener. So if we're talking about big dogs with growth, the first thing we're talking about is large cap. So we look at market cap, which happens to be selected for us, and we're going to basically say that we want companies that are at least $10 billion in market cap. So we'll put in 10,000 million or 10 billion, and that's the first criteria. And if we can then we want to assign a weighting to that how valuable is that as part of the overall quant, and we're going to basically say that that's worth 10% of the overall grade because there's going to be other criteria we use. Now we're also saying that highest market cap is valued more highly, but I'm actually going to flip the default and say lowest market cap because within the large cap universe, I'm going to assume that smaller large caps can maybe have more room for growth than larger large caps. So I'm going to value that a bit more, so that companies that have a lower score, companies that have a lower market cap will generate a slightly higher score. The next criteria we're going to look at is we want to make sure that not only these companies big, but they have high trading volumes, that they're very liquid. We want liquid companies in this. So we're going to look at the 3-month trading volume. So I'm just going to search for that. So I start typing 3-month, and I get all the metrics that match 3-month, and I just look for 3-month volume average, which is right here. And I'm going to ask for that to be bigger than, greater than 1 million shares a day. And we do that. Now I'm not going to actually give that a weighting. I'm just going to use that as a filter. So I'm going to leave this blank here, but I'm going to filter on that criteria so that we only get stocks that trade at least that much. So I'll put that in there, and then we're going to add three criteria that give us our big dog kind of complete the big dog picture. The first is that we want to make sure the sales are growing. So we're going to look at sales, and we're going to pick the sales 5-year average growth, and we're going to ask for that to be uh, at least 5% a year. They have to be growing sales at least 5% a year, and we're going to weight that, give that a 30% weight. And the next thing we're going to look at is the earnings per share. And we're going to ask for the EPS 5-year average, and we're going to ask for that to be greater than 10%. We want to make sure that earnings are growing faster than sales, so that there's efficiency kind of with the revenue growth, that it's enough of it's flowing to the bottom line, so that the earnings are accelerating faster than sales. And we're going to give that also a 30% weight. And we're going to add one more criteria, which is we want to make sure these stocks have price momentum, that they're performing well in the market. So we're going to look at their 1 year return versus the S&P 500. So I'm going to type in 1 year, find all the matching metrics, and there's 1 year return versus S&P 500. I'm going to select that. I'm going to ask for it to outperform these companies to have at least outperformed the S&P by 5% over the last year, which means they're showing strong price momentum, which is another key indication of potential future performance. And I'll also give that a 30% weight. So now what I've got is I've got 5 criteria in the filter, and 4 of them have weights adding up to 100%. And all we have to do now is create this screen. Now we see that the maximum numbers of stocks I can return is 50, but actually only 31 stocks pass this criteria. I'm going to go create it, and let's go see our 31. I'm going to make the inside panel smaller so we can have a better view of the companies that passed. And we see number 1 is Green Mountain Coffee Roasters, and number 2 is ARM Holdings, Las Vegas Sands, which is a casino, is third, all the way down to 31. And if I get the chart out of the way, you can see that a little more clearly, which is CVS, which is the last company that qualifies. Now, if we look at, for example, the number 1 stock, Green Mountain, if we hover over the rank, we can get the whole picture as to why it is selected. So the top part of the quant scoring system shows basically for the 5 criteria what the percentile is relative to all North American stocks, which is just under 8,000 stocks. So we can see that in the area of one year return versus the S&P 500, Green Mountain stock has been a rocket. It's up 183%, which puts it in the top 99th or the top percentile, which gives it a very high score. EPS growth has also been massive, 80%. Almost 80%, 78.9%, which also puts it in the 99th percentile. And market cap is low, so that helps a little. And oops, I want to keep that tooltip there. And the sales growth has also been huge at 57.9%. You can see why it scores so high. It's scoring very high in EPS and sales growth, as well as its 1 year return. And then you can see basically based on the filters why it passes. Now if we scroll all the way down to 31 to get kind of the other side of the score, which is CVS, we can hover over that, and we can see that it's got more muted numbers. Its 1 year return versus the S&P 500 is a little better at 8.2%. That's pretty good. EPS growth just makes the screen at 10.1% over 5 years. Sales growth is at 7.8%. So certainly a very, very strong growing company, but at the lower end of the population that qualifies. Now, one of the things we can quickly do, which is nice, is we just click on chart. We can see Green Mountain is doing very well. If we chart it versus the S&P 500, and we chart over 1 year, and let's flatline the S&P 500, you can see that outperformance of almost 180%, and it had a big jump here in May, around May. Something good must have happened. If we go to CVS, we'll expect to see a much steadier, less outperformance, but still some, and that's exactly what we see. We can see that it's versus the S&P, it's been a slightly stronger performance. But in any case, what you'd want to do is, this is a very interesting population of 31 stocks. You would want to research these stocks and more depth before you commit capital, but it would give you a great starting place, and certainly I'd recommend starting the research with the highest ranked stocks. So that's our first quant screener. The next screener I want to do is something that people are very interested in, which is dividends and dividend growth specifically. So we're going to create a new screen, and we're going to call it Dividend Growers. And again, we're going to use the advanced quant features. We'll give it a description of mid and large cap companies. We're going to look for mid and large cap companies that are growing their dividends and are also strong companies. So what does that mean exactly? Well, it's going to mean it's going to be a lot of criteria for this one. It means a number of things, and let's just jump in. So the first thing we said was market cap, mid and large cap, and typically mid cap is defined as $2 billion or more. So let's put in market cap as our criteria, and we're going to ask for at least $2 billion. And we can see that 2,277 companies passed that screen. That's out of around 8,000, so that's quite a few. But now we're going to start to get more restrictive. So the first thing, because of the dividend screen, the first thing we want to look at is dividend-wise is dividend yield. And we're going to ask for a dividend yield that is between 1%, at least about 1%, but not greater than 5%, because we're looking for dividend growers, not absolute yield, because a number of studies have shown actually that the companies that grow dividends outperform high yielding companies over the long term, because generally the companies are growing faster and doing well. So that's what we're going to look for. Now, the first criteria, market cap, we didn't give a weight to. We just wanted to filter on that. But this we're going to give a weight to. We're going to weight this as just 5% of the overall value. And the reason for that is that dividend growth is going to be more important than yield, and also there's going to be a lot of criteria for this particular screen. The next thing we want to look at is payout ratio. Now, we want to make sure they don't pay out too much of their dividend, too much of their earnings and dividends, because we want to make sure that they have the ability to both grow their business and pay increasing dividends in the future. So we're going to look for companies that are paying out at least 10% of their earnings and dividends, but no more than 50%. And we're also going to give this a 5% weighting. And we're going to actually change the default weighting so that lower payout ratios are better. So the less they're paying out, the better the score will be. And then, so that will be payout ratio. Now we're going to look at the dividend growth rates over 1 year, 3 year, and 5 year periods. We want to make sure that these companies are growing their dividends. So we'll start with the dividend 1 year. Just type in dividend 1 and see what I can match. Nothing, because I need there we go, dividend 1 year. And I'm going to basically ask for that to be at least, actually, you know what, I'm going to start with the 5 year. And I'm going to ask for that to be at least growing at least 5% a year. And I'm going to weight that at 10% of the overall score. So basically the the company's growing their dividend average at least 5% a year over the last 5 years. And then we're going to look at the 3 year, and we're going to weight that a little lower because it's a smaller period of 5%. But we're going to also we're going to ask for a dividend. We're going to ask for slightly more growth. We want kind of, in a sense, accelerating dividend growth. So we're going to ask for 6% yield over the last 3 years. And then when we go to the 1 year, we're also going to weight it at 5%, but we're going to ask for even more growth, 7%, at least 7% dividend growth in the last year. Now that knocks us down to 189 companies that pass this screen currently. But dividend growth is great, but we want to make sure that the businesses are growing to support the dividend growth. So we're going to kind of repeat the process for sales. We're going to look at the 5 year, 3 year, and 1 year. So we'll start with the sales 1 year, same deal. We're going to go 7% growth, ask for 7% growth in sales. Same thing we're asking for in dividends. We're going to give that a higher weight than the dividend growth. We're going to give that a 10% weight. When we go to the 3 year, we're going to go for the same 10% weight. We're going to ask for the same 6% over the 3 years that we did with the dividends. And lastly, the 5 year sales, we're going to give a slightly higher weight because it's a longer period, and we're going to ask for that same 5% increase that we did in dividends. We're going to ask for in sales. That's knocked us down to a mere 36 companies, but we're still not done yet. Similar to the big dog screen, we want to make sure that that we are growing our earnings faster than our sales. So we're going to put in this last 3 set of criteria, the 1 and 3 and 5-year EPS, also ensuring that they're growing faster than sales. So we'll start with the 5-year EPS, and we're going to ask for that to be at least 8% a year that they're growing it, and we're going to give that a weight of 15%, a fairly hefty weight given how many criteria we have. And we're going to give a 10% weight to the 3-year and ask for that to be growing a little faster, at least at 9%. And the 1 year we're going to give also a 10% weight to, and ask for that to be growing at least 10% a year. So we've got a lot of criteria here, but it does magically add up to 100. And if it doesn't, Stock Rover will fix that up for you. But in any case, so we now only have 13 stocks that pass this quite stringent criteria. These are companies that are paying reasonably good dividends, that are growing their dividends rapidly and growing their businesses rapidly. So let's see what we've got for companies. We run it, so we run the screen. We can see the number one company is American Trust Financial Services. Number two is a company called Nu Skin. And if we rank over, we can see all the scores and how they've done relative to all the criteria, and why their overall score is 81.5, which is the highest of the stocks that passed, and then Nu Skin is quite close at 81.1. So again, this gives a very good population of stocks to look for dividend growth. And if you chart these stocks, which you can do quite easily just by, I'm going to use the down arrow on my keyboard. You won't be able to see this, but I can just walk through the stocks and look at their charts basically, and see how they've done relative to the S&P 500 over any period. I'm looking at the last year here. So it's very easy. This particular stock has not done well, even though it passes the screen. So you certainly want to do subsequent research on these names. And the last of the 13 names is Costco. So that's an interesting dividend growth screen that I think would be one that would be names that you'd probably want to consider further research for. The next screen I'm going to do is actually a very powerful screen, but remarkably simple. It's called, I'm going to call it the top screen. So I'm going to create this screen, and we're going to give it the name top screen. Again, we'll enable the Quant filters, Quant capabilities of Stock Rover. And what this is, I'll give it a description, is the top screen determined by multiple back testing multiple strategies. What this is a number of finance professors, I think mostly at the University of Rochester, but basically did research to indicate what which criteria really point towards the greatest performance, the greatest what factors in the past point to the greatest future outperformance. And they found actually that remarkably few things actually seem to matter in the studies they did. And so we're going to replicate that on the screen. So the first thing they did is they again worked with market caps, mid cap and above. That was their choice. So we'll put that same criteria in of greater than $2 billion in market cap. They found basically there were only 4 things that mattered, and we're going to equally weight them. And the first thing was the enterprise value over the EBITDA, and that's an alternative way to value companies from price to earnings, which basically gets rid of the capital structure. So if companies have a lot of debt or if they have a lot of cash, that's kind of normalized out for this. So it really gives a better kind of indication of the true value of companies. A lot of analysts do use this number. So what they found is lower is better for this, and they found that a value, you want to find companies between 3 and 8. If it's below 3, there's generally something wrong with the company, some sort of extenuating circumstances which actually didn't result in outperformance, and above 8 the companies were too expensive. So for this factor, we're going to give it a weighting of 25% because all the factors will have 25%. The next factor they found was important was return on assets. Let's see if we can find that return on assets. Again, a 25% weight for that. And they found for return on assets that companies that had a return of assets of greater than 10% tended to have better outperformance in the future. So we'll put that filter in. And we see that 86 stocks are now passing this criteria. And we're going to also add in 2 more criteria. The next one they found that mattered, the professors found, was return on equity. Again, a 25% weight for that. And they found that return on equity, if that exceeded 18%, that was a fairly solid predictor for outperformance. So these are basically Enterprise value over EBITDA is a cheapness measure. These two guys are efficiency measures of management. And the last thing they looked at was actually a momentum measure, which was the companies were trading well, that they were within 15% of their 52-week high, that they had good price momentum. So we can find that. So if we put in price versus 52-week high, we'll select that criteria, again, 25% weighting. And they found that if it had to be within 15% of its high, so if we'll say that it's 85% of its 52-week high is the way to get that done. And now we've got our screen with 30 stocks that pass this top screen quant. And if we create the quant, we'll see the stocks that pass it, and Seagate on this particular quant is number one, and you can see I'll leave the values up there for a second so you can see them, but you can see its enterprise value or EBITDA is very, very cheap, and its price versus 52-week high, it's doing very well in that regard, and return on assets and equity is fabulous. I mean, that's a great score, 86.5. The next one down is also a disk drive maker. This Western Digital is close to it, and then a company I'm not familiar with, and etc. So you can see the 30 companies that are the ones that, according to the finance professors, are very likely to have future outperformance. Now, one thing that's kind of interesting with this is you can graph the overall screen, quant, to see how it's doing. So if we just chart this, and I'm going to get rid of STX. This is each of the 30 stocks would be weighted equally, and I'll make this a little bigger. And we can see versus the 1 year, we are seeing outperformance, which we would expect because one of the things we asked for is price momentum. If we go back 5 years, we can see that these companies, once we got kind of into the bull market range in January, these companies have strongly outperformed the S&P 500. Obviously, no guarantee they will in the future, and this is not back testing in that these companies are selected on today's criteria, and we're looking back to see how they did do. But it does look like a set of stocks that, in general, will have a high likelihood of performing well in the future. So we've done kind of three interesting screens. The next screen we're going to do is a traditional value screen. So this one I'm going to do a little differently because there's a lot of criteria for it. I'm going to actually, I'm not going to create it, I'm going to import it because I've already got it built on my directory. So I'm going to go to load import file, and this is the value screen here. I'm going to import it, and this is going to and I'll just import it, and then we'll walk through what the screener is. So if I then go to screen for stocks, select value, we can see what the criteria is for this screener. That way you don't have to watch me build this whole screener, which would take a bit. So anyways, we're looking for is stocks that are cheap and are exhibiting some growth. So we're looking for traditional value measures, but we're also looking for stocks that are not only cheap on measures such as price to book or price to sales, but are enterprise value over EBITDA, but also stocks that are showing growth. A lot of value stocks are cheap because they're actually in declining businesses or very static businesses, but we want to find companies that are cheap but also are at least showing some signs of health and growth in the future. So let's look at the criteria. Earnings per share. We want that to be growing at least 5% a year over the last 5 years, and that's not as stringent as the EPS I've been using in the other screens, which was 10%. But this is a value screen, so we're not going to be stringent. Earnings. This is very similar to the top screen, but we're going to go between 2 and 7 on enterprise value over EBITDA. We want to make sure they don't have too much debt, which is something we haven't looked at in the past. So we're going to make sure their long-term debt over total capital is less than 20%. We're looking for a market cap of at least $100 million. I mean, not looking for huge companies, but at least substantial, decent market cap. But there's still many small caps that would be in that category for sure. Price to cash flow less than 8 times. Price to earnings less than 10 times. Price to sales less than 2 times. And we're looking for not only we'd look for growing earnings of 5% a year over the last 5 years, looking for sales growth of over 2% over the last 5 years. And then these are the valuation of the criteria. The ones that are 20% were valued highest, such as the enterprise value over EBITDA, the price to book, and price to earnings, which were the traditional value metrics. So we have all that up there. We can run this screen. And we can see that how many stocks do we have on this screen? 28 value stocks have met the criteria. And if we go to the profile view, we can see what these companies are. Like, for example, if we look at them, well, now they're sorted alphabetically, but we can get an idea of what their market caps are and stuff like that. Let me just run that again on that so I can get the rank in there. So we can see that running this quant on the value stocks will give you kind of just with the profile view will give you kind of an idea of what we're looking at. Some very small companies. The first two are reasonably small. Then an energy company, which I guess is a Russian one, and then just a variety of companies. And if we pick a company and a variety of exchanges as well that traded in different places, but if we pick, for example, Holly Frontier, which is an energy company, and we mouse over, we can see again the criteria and see why it passed the screen and what its values are. So if you're a value person, this would be kind of I think a reasonably interesting set of stocks to look at. One thing we can look at is, well, how is the value screen done? So let's chart it. Again, this is not back testing. This is looking backwards at how these stocks have done, and we can see over a 5-year period they've gone up quite a bit. But if we do a benchmark versus the S&P 500, and we flatten that, we can see that the value stocks in general have indeed outperformed the S&P 500. If we look at shorter periods, we can see it's been, growth has been it has been in favor really in the last couple of years. We can see that value is basically oscillated around the S&P 500 without tremendous outperformance or underperformance. But value is definitely a long-term proposition, and if that's something you're interested in, this would be a screen that would do that. We're going to do another screen that's really on the other end of the spectrum, which is what I call small cap rockets. These are going to be small cap stocks that are growing very, very rapidly. So I'm going to create this screen. Call this small cap. And small cap rockets, and we're going to find small companies. I'll put a description in. Find small companies less than $2 billion in market cap that are growing sales and earnings rapidly and are also showing strong price momentum. So these stocks are going to be real, real powerhouses. It's the real question is obviously whether that's going to continue in the future. But let's look at the criteria and see what we get. So market cap, small cap. So we're going to ask for at least $500 million of market cap, but because it's small cap, no bigger than $2 billion. Let me turn on the quant features here. We're not going to weight that. We're just going to use that as a filter. And we're going to look at the 1 and 3 year sales histories. So we're going to start with sales, 1 year change, and we're going to ask that. We're going to say the sales. We want them growing their 1 year sales basically at least 12%. And we're going to give that a weight of 15% of the overall quant. And then we're going to do the same thing for sales 3 year. We're going to give that a higher weight because it's a longer period of 25%. We're going to ask for sales growth of 3 years of at least 10%. And we're going to repeat the process for earning per share, the 1 year earning per share. We're going to give that a weight of 15%. And we're going to ask for earnings per share growth that exceeds sales growth and is at least 15% a year. And then the 3 year, because it's 3 years, we'll give it again the higher 25% weight, and we're going to ask for 3 year earnings per share growth of at least 12%. And then we're going to look at the returns. We want to make sure that 1 year and 3 year returns versus the S&P 500 are significant. So we're going to first look at the 1 year. Get that one up here. We find that 1 year. 1 year return versus the S&P 500. We're going to give that, first of all, it's weighted at 10%. And we're going to ask for the returns to be at least 5% greater than the S&P 500 over a year. And then we're going to do the 3 year, also weight that at 10%. And we're going to ask for that to be at least greater than 10% return overall versus the S&P in that 3 year period. So we've got companies that are outperforming the S&P, that are small, that are growing sales and earnings rapidly. 37 companies pass this screen. We run the quant, and we can see the companies that passed. For example, On Assignment, which is a reasonably big company, has a $1.3 billion market cap. And if we mouse over that, we can see the scores and why it's ranked so high. It has a 1 year, the 1 year and 3 year return versus the S&P 500, a huge. We'll see that. We'll chart that in a minute to see that. But earnings per share growth in 1 and 3 year period and sales growth has been huge for this company. Obviously, a small company, you want to do more research on it, but it's clearly a powerhouse as far as price performance goes, and seems in their business at this point. So if we chart it, um, let me chart this guy. You can see it's growing quite nicely. That's a 2 year chart. Let's put that against the S&P 500 to give it some context. Let's flatline the S&P, and you can see massive outperformance versus the S&P last year, last 2 years. Even if we go 5 years, you can see, well, it looks like something really happened in their business and they start accelerating. So that's something you would want to research further. But anyways, an interesting population of 37 stocks or so that are small cap rockets that um, would be what I'd call high return and potentially high risk companies to consider. The last screen I'm going to do is one called Oversold. This is an interesting screen. It's actually great to do now where the market's run up a bit. Now has been a bit choppy, so we'll call this Oversold. And we're going to look for the description is we're looking for strong price performance stocks that are oversold, that are recently oversold, and the theory that they will bounce back. So what does that mean? Well, we're going to start with our usual. We're going to look really only at returns. So we'll start with basically companies that have outperformed the S&P for a long period of time but recently have tripped. So what does that mean? Well, we'll start with the 1 year performance versus the S&P. And we're going to, let me put the quant features on so we can get the weightings. And we're going to ask, we're going to give this a 15% weighting, and we're going to ask for a 1 year return versus the S&P at least 2% greater than the S&P. We're going to look at the 2 year return of the S&P, also give this a 15% weighting, and we're going to ask for this to be greater than 3%. And then we're going to look at the 3 month return versus the S&P. These are all going to be returns versus the S&P. We're going to ask that to be greater than 1%. And we're going to do the 3 year return versus the S&P. Also giving that a weighting of 15%. Asking for the 3 year return to be greater than 5%. And last will be the 5 year return, which is also going to get a weighting of 15%. We're going to ask for the 5 year return versus the S&P greater than 10%. So what have we done? We've basically said for all these periods, from the 5 year return down to the 3 month return, we're looking for outperformance versus the S&P. But with the oversold, we're going to look for a recent stumble, which means we want to look at the relative strength, which is a technical indicator. So if we look at the relative strength index, typically that means that if stocks are overbought, they're 70 and above, and if they're oversold, they're 30 and below. So we're going to say we want them to be less than 30%, or less than 30, so that they're oversold. And we're going to look for companies with the lowest relative strength index, in other words, the most oversold. And we're going to give this a fairly high weight of 25%. So these are stocks that have been doing really well versus the S&P and have recently tripped. And the theory is that because of the strong period of outperformance over a long period of time, that the recent trip is probably just just a short-term thing, and it'll resume its performance. Now, you'd really want to do your investment research to make sure that that's the case, and there isn't a larger issue that's making the company actually making their prospects in the future not so impressive. So this is a screen that really would require subsequent research for the ones that pass. But let's take a look at what we've got. So we run this. We get 50 rows. Looks like we hit the max on the number of rows. And now I can go back and change the screen and allow more in there, but 50 is plenty. And we see the companies that pass, like for example, this Cheniere Energy has an RSI of 23.6. Kieran Holdings RSI is only 17, etc. So if we chart these companies, what we would expect to see is what we're seeing here, which is let's go to a 1 year chart. Might be a little easier to see. Kind of a recent dip versus the S&P 500. We might see that on a 1 month chart. Yes, you can see recently underperformance, but kind of a long history of outperformance. And I think you'd see that as we step through this chart, you'd kind of see that pattern repeated over and over again, whereas very recently a dip. So these are companies that have been generally going upward, but are currently experiencing some sort of problem or pressure that's resulting in a negative performance of the stock, which may or may not continue. And if you think that it's not going to continue, for example, NetSuite, this has been a fairly solid stock versus the S&P. If you feel it's going to connect to this trend line here, that it might be resuming kind of its upward ascent. So in any case, what the point of quants is to give you populations of stocks, to research, to do further research, and order them for you so you can be efficient with your research. And what I've done is demonstrated 6, I think, very interesting quant screens that I hope you will find useful. So I thank you for attending, and as always, if you have questions or comments, feel free to contact us at feedback@stockrover.com. And I hope you found this useful, and I hope you explore and dig into quants. I think if you do, you'll find them to be a very valuable part of your investing experience. Thank you very much.